And good evening. This is the Eye of the Storm podcast for the S&P 500 and the NASDAQ 100 as I go over the big picture update. And then also I'll include what expectations may be for tomorrow. Starting with a little bit of background to how I arrive at my counts and how they are functioning now and why I continue to run two counts. And it also helps answer a question that I have received quite a bit in the last week or so, and that's regarding, have we bottomed? Have the markets bottomed? The rallies have been very strong, no doubt. Friday was a truly remarkable day in my mind, not because of how high the markets went, but because how thin the volumes were. But yet they just marched higher. And so just to touch on Friday before I begin the deep dive, Friday was, in my view, a short squeeze. And it was a short squeeze that just got worse and worse as the day progressed. And by the end, it was no choice. Covering was the only choice they had. There was nothing left. And the sellers were absent. We're not there. They were just standing back like, this expiration's not ours, it's theirs, and let's just have what they choose. And that's pretty much what happened. Now, as I begin, I am going to go out to my maximum monthly chart for the S&P. And within it, I continue to discuss how we have finished or completed at that all-time high, which so far is still 4808 in the S&P and 16,768 in the NASDAQ. And those are still pretty firmly in place in my mind. But what I want to talk about is that to answer the questions that are coming to me, that is there a possibility that the S&P and the NASDAQ finished their corrections and made a bottom on June the 16th, June 16th, June 17th. And before I can really answer that, I need to fill in quite a few blanks. But to put a quick answer out there, yes, there is the possibility that the S&P and the NASDAQ put in a bottom on June the 17th. But to fully understand it, I need to take a look at the bigger picture, or actually we need to take a look at the bigger picture and to decide which degrees are in operation. So with my Elliott Wave count, it suggests that the S&P and the NASDAQ finished at the all-time highs, an intermediate wave 5, a primary wave 5, a cycle wave 5, and a super cycle wave 3. Now, I'm just going to try to get this open so we can see that. So we have an intermediate wave 5, a cycle 5, a cycle 5, and then a super cycle wave 5. And I'm sorry they're all scrunched together there. Let me see if I can get those moved out. Let me get rid of this. This is important. I need to just us to see how this all is coming in. And let me put that up a little bit more. And now we can see an intermediate wave 5, a primary wave 5, a cycle wave 5, and an intermediate third wave. Now, again, just giving a brief overview of Elliott Wave. Elliott Wave performs the best, or what it really does is that the whole principle is based on that the markets are really involved in building blocks. So these same patterns will exist on a 1-minute chart, an hourly chart, a daily chart, a maximum monthly chart, all the way up as far as you can get. You will continue to find the same patterns. So the highest degree that I'm counting at the moment is a super cycle. Now, there is one above that, and that's the grand super cycle. And the extent to which a grand super cycle remains in force is, let me just say that the super cycle wave 3 in both the S&P, not so much in the NASDAQ, but in the S&P, began in 1932. In the NASDAQ, it began at the beginning. So the NASDAQ really started, if we had to run it together, at a much higher level and reached its highs at the same time here as the S&P. And now they have much more in common. But leave it to say that on a supercycle degree level in the S&P, it's took over 90 years to get up here, or 90 years, let's just say. Now, having said that, so that the count that I'm using right now suggests for both the S&P and the NASDAQ that they finished at those all-time highs an intermediate wave 5, a primary wave 5, a cycle wave 5, and a super cycle wave 3. So therefore, the S&P and the NASDAQ have started on a super cycle degree wave 4 correction. Now, having understood that, so this larger and longer term correction will consist of an ABC pattern on an intermediate degree, a primary degree, and a cycle degree. So the general rule that we need to follow here is that when a larger degree correction is in progress, all lower degrees will follow the same pattern, and that pattern is or are ABC structures. So again, we go back down. We're starting in the intermediate degree. That's the smallest degree. It'll move the quickest and build to the primary, build to the cycle, and then complete the super cycle. So here we are starting here. Now, so if we go back to the current action, off of the all-time highs, and I'm using the S&P right now, so off of those all-time highs in the S&P, it started the corrective process on an intermediate degree. So which on my charts, that's labeled in yellow. So currently, I am running, for those that who follow me, I'm running two views parallel to each other. Both are tracing out the initial intermediate degree ABC. View number one suggests that the low on June the 17th is completed the minor first wave of an intermediate wave C. Okay, so it's in there, we just can't see it. But now I'm going to bring this down. Let's take a look at the weekly. There it is. So I can pull it over and we can just make it a little bit clearer just by moving that out of the way. And I'll move these guys out of the way. First of all, let me get rid of this right now. Move this out of the way. And this out of the way. And there's the minor. So that it completed a minor wave 1 in an ongoing intermediate degree C wave. I need to move these out of the way actually as well. So let's move that over here and this over here, just while we're talking what this count is covering. So, and then view number 2 suggests that the S&P and the NASDAQ completed the intermediate wave C, and in turn, the primary wave A also at that June 17th low. So this would not be a minor 5, a minor 1, it would be minor 5, which then completed intermediate wave C, which then completed primary wave A. Now, going back to that top again, what we are doing, if we are completing an ABC And that's now done on the intermediate degree. That completes primary wave A. So now we're going to have to do an ABC, but on a primary degree. So here we are again. If this completed primary wave A here on that June low, then we're involved and putting in the initial intermediate degree A wave. So it's intermediate A of primary wave B. Then we would then have an intermediate wave B, and then an intermediate wave C, and then that would be primary B. What follows on the primary degree is that we then go down, we decline in an primary degree C wave. And what will that do? That then completes the cycle degree A wave. So I've talked about this before, and it's just the building block theory. If it works for the market going up, it's the same thing for the market correcting. It all goes in sequence, and all sequences operate in the same direction, in the same structures. Corrective structures are ABC. When we're in trend, and actually a bull trend, there would be 5 waves. So it would be impulse waves, impulse waves counted 1, 2, 3, 4, 5, corrective waves counted ABC. So here we're in a larger correction, still going to be counted as ABC. Within that ABC, you may have 5-wave structures because an A wave can come in as 5 or 3. So A waves can be their own ABC. Right here, we got an example, if indeed that's the case. Or they can be 1, 2, 3, 4, 5, as it was here for intermediate wave A. So, and then again, 1, 2, 3, 4, 5. Indeed, if this is intermediate wave C, it fulfills that requirement of all C waves are 5. All C waves are 5. 5 waves. That's the observation. That's the rule. Okay. So what has happened here? So if view number 2 is in force off of those June 17th lows, the S&P and the NASDAQ have been in the process of tracing out a primary degree B wave. So remember, all subsequent lower degrees will form ABC structures from intermediate to cycle to complete that supercycle degree wave 4. Within primary wave B, then, the S&P and the NASDAQ may have reached or nearly has reached the top for an intermediate wave A of that primary B wave, as I just described. So now, let me discuss a secondary question that keeps coming up about that the current rally, right? This guy, the current rally, closing above the 50% retracement of the entire decline thus far, that does suggest that there is a theory that a bear market would be complete once the market breaks above the 50% retracement level. To answer that, which has come up more than once, I do not follow that theory. I do not use that theory, but I do use Elliott Wave, which gives us a different look. So back to the views that I presented. There is a strong possibility that the S&P and the NASDAQ completed intermediate wave A of primary wave B, or under this, that would be under view number 2. Under view number 1, a minor wave 2 within an ongoing intermediate wave C. When it's complete, then it will form a primary degree A wave. So hopefully you can see now how these counts are basically forming the same moves within the larger term corrective process, but the difference being the breakdown within the intermediate ABC. So I know it's really quite confusing, and to get a little bit, stepping back and get a little bit bigger picture, hopefully it's going to start to make more sense, and we can put some form onto what that low in mid-June actually was. So now let me just talk about that underlying question that's come up so many times. So I believe that truly the question at hand is, do I get long or do I stay short? So let's look back to the fact that on June the 17th, it did mark a bottom. And that bottom may be on a minor degree or an intermediate and primary degree. So as I've laid out in my updates, and again, just now. So that would make the low more important once we understand the degree it is. And once that is established, then we can determine how far the anticipated rally will go. Therefore, we need to note this and trade accordingly. So to sum it up, yes, June the 17th was a bottom, a tradable bottom. And as a trader using Elliott Wave, I would not be looking for a long-term buy, nor would I be looking for new all-time highs from the S&P or the NASDAQ. The ultimate back up the truck and load up on long positions bottom just has not occurred yet. And yes, there should be stronger bottoms coming up where taking a larger and broader long position will yield strong gains. But I am going to urge caution and carefulness on getting in now. So back to taking this deep dive. Here, we're going to continue to look at the ES. I will go over and I will be checking out the NASDAQ as well. So again, what we're looking at is how the longer-term correction will unfold. So to put the June 17th bottom in place, yes, it was a bottom. Yes, it was a tradable bottom. But what was, I think, maybe more confusing, and this I do take responsibility for, initially I felt it could have been that this was a minor third, and that we're going to do a minor four and put in that fifth wave. And at the time, we were looking at 3550, maybe down to 3500 for that minor five. And that then would have completed the intermediate wave C and the primary wave A. Now, when that fell through, because it ended up not being a triangle, that brought about a little bit different situation, because wave four really, at this level, too big, way too big. So that got eliminated, and that then brought this up. But when I'm making the updates, this was a strong push off, which gave a lot of strength to whatever happened here, whether it's wave one or whether it's wave five, at a minor level, it put in a tradable bottom. Now, if you are looking for buying, so because you believe the market's going now, if that's the bottom, we should now go and make new highs, that's where the trouble begins. It is a tradable bottom, but only for the length or the strength of this corrective pattern. So we can set up, and I did along the way, Fibonacci relationships for the up move. And as it continued, we continued to make adjustments. If you are intending that you want to trade these moves, or you believe that also is a tradable bottom, and there are particular stocks or particular options that you want to put into place to take advantage of that, why not? It's great. But putting it into perspective as to exactly what's going on is what I'm really trying to now help get established. Yes, it was a tradable bottom. Yes, the market went up. No, I do not suspect or even look for new all-time highs in this market. So what needs to take place now is having a little bit better understanding of what are the possibilities within the intermediate wave A, within that possible primary B wave. What are the possibilities for a wave, minor wave 2, before we begin our next move? Those can be done through Fibonacci. So let me go down. I think I can do these on my daily. So let's go down to the daily, start filling in the blanks. I'm going to show you this is my process. If indeed we're looking for wave A, what is wave A doing? Well, it's going to start coming up in the B wave. And so what is that B wave? If this is wave C, then I'm going to put just basic retracements under the whole thing. And I'm going to do it right like that. Now, what I'm putting in is the entire primary B wave. If this is what's enforced, here we can look at what the possibilities are going to be. So we're already getting ready to get up to 618. Now, wave A, yeah, you can get up there or it's going to stop here. So we are very close, and we've now surpassed a lot of levels, but it's a wave A within a larger B wave. A's can go up here to 50% to 618. So this is what threw people off. They threw Fibonacci's on here. It broke that. Bear market's over. I don't really work on the basis of declaring that something's in a bear market, something's in a bull market. I tend to just go and trade the price action. That's number one. Number two, I use the Elliott and the Fibonacci rather than, oh, it broke that level, we're out of the bear market, we're back in a bull market. I don't do that. I think that can create a lot of confusion and a lot of problems. Now, so where can we go? Now, again, if we have that, or if this is now complete, and now we're looking for the start of either a minor third or the intermediate wave B. Intermediate wave B would also be an ABC structure. And in here, if this indeed becomes ABC and it's complete, then we have the possibility that it's going to come down in another ABC, and intermediate wave B could be a flat, which means it goes from here and it comes back down to around here. Now, also, under the other view number one, if it's a minor third, it's going to come off in 5 waves. Minor 3 would be expected to break 36.39, which is the current low. That was on that June 17. Intermediate wave B would not be expected to break to new lows. In fact, we can run some additional fibs. Let me remove those, go back to just straight fibs. And now we're looking for B wave down. And I did that on the wrong side. Let me just get rid of that and go from here to here. And that's going to give us our numbers. So coming off, we have support at 41.32, 40.39, plus our moving averages, but we're just doing fibs, 39.63, 38.80, 88, then 38.32. Now that, a wave B, 50 to 60, 50% to 618% of the A wave. So we're already back down to 38.88, possibly lower. We know that it can come back to 36.39 or in that neighborhood. So, and these will be refined a little bit because I'm off 5 points on the bottom and I might be off a little bit on the top. But that's how I come up with the levels. Now, because I'm not going to want to operate on a bullish or a bearish posture, I'm going to be actually just following what the fibs are and what the market is actually doing and trading the price action versus taking a bullish or bearish posture. Does that mean you can't trade the downside? Once this top is in, then we're going to go down. We will go down. The severity will still be left out. So I don't know. We have 2 counts running. Both are viable. Both carry different pictures, but basically are still following what we described or what I described to begin with, that all of the subsequent below, if we're in a super cycle wave 4 correction, that means on a cycle level, a primary level, and the intermediate degree level will all be operating in the same structures, A, B, C. We got to do an ABC on an intermediate degree, an ABC on a primary degree, an ABC on a cycle degree. And that will then form in its entirety the super cycle wave 4. So we're at that juncture where either the C wave is going to be quite a bit larger, or it's in and we're going to do a B wave, and then an intermediate B wave, and then another rally. And that rally will be expected. Seriously. From here, if it only comes down to here, then we're looking at the possibility that it's going to turn right around 46, 47, maybe even go up and test that high. And that all can happen before we get a primary degree C wave down. So you can see how when we're trying to play outside of just the price action and what the wave patterns and what the Fibonacci are telling us, we get wrapped up and it's all bullish, it's all this, it's all that. The Fed's going to relax, the Fed's going to do this. Nobody knows 100% for certain what the Fed's going to do. We have an idea. It's like, well, they're all inflation's under control now. Why? Well, because you see crude oil's coming down. Gas is now back below $5 a gallon in most of the country. Here in California, we're still well above $5. Getting there, but we're above $5. So when you start tossing all that in, it's what I call the pundits. This is their job. And I want to tell you right off the bat what I have been told. And I found it a little bit, crazy, but it's true. Bear pictures, bearishness does not sell airtime. So you're not going to hear it from CNBC. You're not going to hear it from these people. What you're going to hear is, oh, inflation's under control, inflation's this and that, and boy, the Fed's they're going to relax now. Hey, man, they got to step back. Now, again, I'm going to take you back out to that monthly max. Look at this. That's all done. We've corrected all we need to correct, and now the rally's back on. We haven't even got down to the bottom from where this whole thing started and where the last kick-in came for spending and printing trillions of dollars to bail out the citizens of the United States as we sank and got isolated within COVID world. What happened when that took place to produce this bullish picture? Well, cheap money. Interest rates dropped and dropped and dropped and dropped. Every last corporation stood up the window at the Fed and said, yep, I'll borrow. Yep, I'll borrow. At those rates, you betcha. Give me all you got. And they were allowed to because they then were expecting that they would then bring back their employees and pay them. So they'd be able to continue to operate, thus keeping our overall economy going. Now, in that process of borrowing all that money at a low rate is inflationary in and of itself. Printing that much money is inflationary in and of itself. So when this thing starts to drop, and then we've got other problems that are aggravating it. We have wage inflation, right? Everybody's coming out of school, or they're all looking for jobs in tech. 250,000 minimum. That's what I'll come to work for you for. We're starting to see a little crack in that path. What else happened? We had supply chain problems, from microchips to food to every product that we can get our hands on, construction materials, etc. Everything starts to get in short supply. That's inflationary. We watch the prices go up. So how do we control inflation? We take money out of the picture. How do we do that? The Fed raises interest rates. Now, I dare say that within the last couple of generations of traders, they've never been through a high inflationary period, because the last one that you can compare to the one that we're in was in 1981. But you need to go back to 1981 to realize what caused that. All of the money and dropping gold, dropping the gold standard, number one, basing everything on a fiat currency, number two, and then printing a lot of that fiat currency. Because essentially what we did is like, well, we don't have to back it with gold, so we can just keep printing with impunity and we can just buy our way out of all of our problems. And that's basically what happened. So once we got up to a point where inflation was too high, like in 1981, they had to stop the borrowing of money, make money more difficult to get your hands on. So interest rates went up. Now, and they went up a lot. I was there, I was trading, and I'm telling you, the prime rate or the Fed fund rate got up to above 18%. I think got up to 21%. 21%. Currently, the Fed fund rate is like maybe 3%. Big difference. And so this concept of, well, you know, the Fed will just start printing money. Not unless you really want to go into hyperinflation. Not unless you really want to see everything just start to collapse. And that's essentially what will happen. So what we're expecting or what we think based on that's the way it's been is based on no experience. It isn't as always the way it's been. Now, back to our market. Again, trying to determine bullishness or bearish is not going to be the best way to trade, to be honest with you. Unless you pick up some new skills, that's how you've been taught. You buy and you hold. Look, market, you buy it and you hold. Look at the market. You buy it and you hold. Look at that market. What would you think what people were talking about there? We watched 401ks get annihilated. And people had to take their money. People had to close them out. People had to do a lot of things that they didn't like to do. People lost money. And then in the housing crisis, back in here, people lost homes. People lost massive amounts of money. All right. How did we get out of it? We printed money. What did the government do? And I'm not saying anything about being a Republican or being Democrat here. It's the government, and that's the government's job. But the government printed money. And then they printed enough that we could rescue the banks, that we could rescue the auto industry in Detroit, that we could rescue corporate America. Because corporate America is going to keep public America, retail America, in a job that keeps the money coming in, keeps the money flowing, keeps the economy running. So it's always the same thing that they need to do, right? The Fed needs to kind of keep us all in jobs, keep us all working, keep the tax base going. Now we get to add everything else into the picture. Again, I'm just going to say there remains a lot of hotspots within our own country and outside of our country that are not resolved yet. Now, first thing I will talk about is the infrastructure package, which has many components, that got passed by the Senate, then by the House, and now goes to the president's desk for signing into law. In a big 30,000-foot view, it is bullish, I have to say. It's going to create some inflation because we're printing money. It's going to create a little bit of a wrinkle here and there because part of what got put into there is that, and I'll tell you who got some of it changed: hedge funds and portfolio managers. Hedge funds, mutual funds, big firms. There were tax increases that would have been placed on them that would have made it a little bit more difficult for them to actually function. So that got taken out. And how do they do it? They paid Senator Sinema. And she threw her vote out until she got what she wanted. Now, regardless, okay, it happened. But it has been passed. So $300 billion will be pulled in to help pay for all of this needing to be done in this package for the country. from corporate, an increase in corporate tax. Now, that actually still needs to filter through. And how is that going to affect earnings? How is that going to affect how the corporations move ahead when maybe they're going to be having to spend $1 billion, a couple of billion paying taxes? I don't know. We have to wait and see. But that's still out there. Trust me, not even thought of. But it is going to put a bunch of Americans or people to work. We're repairing our infrastructure. We're looking at repairing roads and bridges. We're looking at installing charging stations. We're looking at improving the electrical grid. We're looking at improving the internet. We're looking at the broadband. There's so many things that our country needs. And the government is really the one that needs to stand up and put it into place, because obviously corporate America is not going to do it. So, and we all need it if we want to continue to work and do our jobs and just be functional. So it is a bullish package. More people that go back to work, they're not looking for subsidies. They're not looking for unemployment. They're not looking for things that could earning money that increases the tax base, that increases the government's ability to function and to pay its bills. So long term, though, it's going to take a while. Now, what's going on now? Well, I think this has been a very typical either intermediate degree wave A or a minor degree wave 2. As a minor degree wave 2, we go, oh, that's so high. Not so. That's how high it can get before you have to negate that count. Now, I'm not necessarily looking for that. I would likely switch it over before, but that's why I'm running both together. As a wave A, I'm not looking for it to go up that high either. We had right here, we had 43, 24, 25 up into that area. And it could get there because it's getting spun as the best thing since sliced bread and you're missing your opportunity. So what do we really get going on here? And unfortunately, with a lot of people on the retail side, fear of missing out. What did they do? Well, we saw year after year after year of the market just going up and going up and going up and racing higher. Well, you better go back and look to see what created that and what fueled it, because you're going to need the same thing. And right now, folks, interest rates are not dropping. Granted, someone's going to come back and tell me, oh, yeah, they are. The long end of the curve is going down. The short end of the curve is what's going up. And it's like, that's true. But go back and look what happened to the last 30-year auction. And that was last week, Thursday. The rate went up. So mortgage rates back up. So again, when you start to see the curve flatten a little bit, how do you want to interpret that? So this narrative of we're in a low interest rate environment, we're going to go back to low interest rate, the Fed's going to get dovish, they're not going to raise anymore, that was a bottom. First of all, I will agree that was a bottom. I will not agree that the Fed will get dovish and not more hawkish and not produce a 0.75 of a basis point rise, a hike them that in September. In fact, we still got surprises because I can't see into a crystal ball to tell you, well, this is what's going to be happening in the world. This is what's going to be happening at the Fed. This is what's going to be happening within our country. This is what's going to be happening with personals and retail and corporate. We don't know. All we know is to buy or sell on history, right? Earnings. Oh, wow, look at what Apple did. Oh, wow, look what Amazon did. Oh, that's so bullish, bullish, bullish. It's like, well, I don't know if I put it that way because you just bought history because they think they're going to continue to do the same thing 6 months out. And gee, the market always looks forward. We don't look back, we look forward. Really? That's a whole big spin, isn't it? If you decide you're going to buy Apple because of the earnings they said and the forward guidance that they don't expect a slowdown in iPhone sales. Well, if there's less money in the hands of the people that are going to be buying the iPhone and they don't lower the price, but they continue to raise the price, then I think that that's not a valid statement. But we'll see what happens. No one is able to tell you with certainty what's going to happen next week, let alone in 6 months. Again, you've heard me say, and I will continue to say, the status quo has been under siege. It's getting shattered. The status quo is like, well, that's the way it's always been. How many times do we read the news and say, if you invested $1,000 in Amazon in 2004, you'd be a bazillionaire right now. Had you bought Apple at $4, and trust me, I was a trader and saw it trade there. Saw it trade $20, saw it trade $40 without the benefit of a split. Right? These things did happen. But had you bought that, then you'd be a bazillionaire. Now, okay, true statement. But what are you telling me that for? Because you want me to go in and buy it now. Because why? Well, because everything's going to just chug along, because that's what the market does. Well, truly, only when it's based on reality, based on what's actually happening in an economy, based on what the Federal Reserve is doing, based on what corporations are able to do, based on a supply chain that doesn't break down. There's so many things that affect this. How could you possibly say, well, gee, the last 60 years, if you invested in the S&P back in 1962, well, look how much money you would make. That's what I think is breaking down. Now, we're also talking about that we need and want to go back to normal. What is normal? Normal would be pre-COVID. What has COVID done? It's really shattered that whole concept. We need and still have not gotten to the new normal. How do we function now? I don't know about the cities where you guys live, but I live in San Francisco. San Francisco is in trouble, folks. It's in trouble. So much relied on growth within these tech stocks, which they all came in and rented huge amounts of office space in downtown San Francisco. Well, they're empty. And then we had firms such as Square, aka Block, Twitter, Microsoft, Google, Facebook. You can work from home indefinitely. Now they're taking that back. Now they want people to come back to the offices. Yeah. So a whole section of the economy has been ripped apart and destroyed. Commercial property, rents, people that own those buildings or corporations that own those buildings, all of the businesses in the surrounding area that support all those people coming to work, gone. So step by step by step. Are we back to normal? Not at all. We're still struggling everywhere. Now, back to the markets. That's why I don't take a bullish or bearish posture. That's why I really don't want to say this is what I think or for certain will happen. Now, I do include, and this is also what I'm trying to do today, is kind of just pull in how I do my analysis, what it's all based on, and why I give two views, because they're moving in parallel with one another, and one way or the other, one will take over. One will be what is actually in play. But that does not suggest, either of these does not suggest that we're moving back into a bull market, that we're moving back into a market that's going to eventually go to new highs. The only one that I could squeak out with that would be the primary B wave. Primary B wave, I could squeak out that it could possibly come down in a B wave, rise in a C wave, and go above 4808, and then turn around and crash. That I can say. Now, But I can't tell you that's what's going to happen. Day by day, I got to take this. So again, when I'm being asked, is that the bottom? Is that the bottom of the bear market? No, that's not the bottom. We still have quite a bit to correct, right? If anything, we're correcting from 2009. 2009 to 2020, 13 years is what's really need to be corrected. The 2009 lows in the NASDAQ, I actually was at like 1,000. In the S&P, it was I'm going to use 667. 667. We're trading at 42.72 right now. That's 3,600 S&P points below us. Then I think the markets will correct and likely end up in that neighborhood within the next 10 to 12 years. So to call the bottom, and we're going to go back to new highs now, after what? 7 months? 8 months of a correction? Wow. That would be miraculous. That would mean a lot of things are totally taken care of. Are they? No. Do we have high hopes? Of course. Am I a perma bear? Absolutely not. Am I a perma bull? Absolutely not. I'm just looking at what I see and I'm tossing in the mix what's actually happening to us in the world, in our country, economically, and then going, okay, do I see that we're operating on all cylinders across the country? That we have all these people going back to work, which, by the way, please don't get roped into that all these people going back to work is bullish. It's bullish for them, for the country, and for not the country. It's bullish for the country. It's bullish for those people because they're going to be making money, etc. Well, it is also inflationary. So we're always going to be operating with a double-edged sword here. And so that can be part of it. Now, I'm going to now turn away from that background and how I come up with these counts, which is nothing more than just reading and my Elliott experience and my knowledge of Elliott and Fibonacci, and combining it with what I see happening on the outside world. So before I'm going to make a determination that we're done with this correction, we got to at least be looking at a cycle degree level. And we're far away from that cycle degree level coming into play. We're still working on finishing up an intermediate degree, then moving to a primary degree, and then to an intermediate cycle degree. But please don't misunderstand me. They're all working in conjunction with one another. So what we are, in essence, really working on, all of this, is a cycle degree A wave, a primary degree A wave, and or possible B wave. And whether we finish the first ABC down for the intermediate degree. Then we go up one if we did. So what's going to be within this primary degree ABC? On the A wave, it's going to be an ABC. On the B wave, it's going to be an ABC. On the C wave, it's going to be 5. Those are the wave patterns. But then we're just forming cycle degree wave A. What's going to be in there? An ABC on the intermediate degree and ABC on the primary degree. And that's going to form cycle wave A. Then we get a cycle wave B. What's going to be in there? A primary degree ABC, an intermediate degree ABC, et cetera, et cetera. So as we work up, you work down. All right, we got to fill all the blanks here. And then once we do a cycle degree ABC, you can label it super cycle wave 4. Then that's when I'm looking for a very strong incredible economic expansion on a global basis. And it would come in a supercycle wave 5. Now, it's out there, but I got to pull it all in because guess what? I got to get up tomorrow and trade this market. So, daily chart. Now, let's just talk about this. Again, on Friday, I'm going to take that off so we can see this. Friday's trade was, again, in my opinion, a short squeeze. And what really kind of forced it again was Apple. Apple, Amazon, Google, Meta, Microsoft, NVIDIA. Now there's one. Let's just talk about NVIDIA. NVIDIA came out, what is it, a week ago, maybe? And said, hey, you know what, folks? I know that corporate's looking for $8 billion in revenue from us. That's their estimate. We're not going to make that estimate. And they said, what they are going to report is $6.2 billion. They tore NVIDIA down. And it was trading below 170. It closed on Friday for the expiration at 187, and they bid it up afterwards. So the short covering in NVIDIA continued after the market closed. And when I see Apple close at 172, they didn't, the people who probably got long at 172 didn't want it and were looking to sell it. This is just posturing, right? But you can start to see what they're doing. It was a short squeeze. The volumes were incredibly low. This is all changed now because we're open. But 301 million. The S&P traded less than 1 million contracts all day. And for an expiration on a market that was rising as strongly as it was, I was like, whoa, this is, again, we've seen it before, an absence of sellers because they needed to find the buyers themselves. It was a short squeeze. When you have a serious absence of sellers, nobody's going to step in. It's because you're being forced to buy it. And nobody else wants to get on that boat. Not in face of an expiration. Not going to happen. So again, you look at what's actually out there and then you put together, it's like short squeeze. What could this be telling us? Here in the S&P, I've been looking for the completion of this small fifth wave, and that may be it, maybe not. Otherwise, I think we'd be dropping quicker. So we have to now leave open that we're going to make one last charge for 4,300 to get above. And then, so I should probably move this. So then, what then? And once this is complete, again, the story remains the same. What am I looking for? I'm looking for the market to reject the level, number one, and for the sellers to come back. Because all of these new longs, you're going to want to get out. You know, it's just, if you want to talk market talk, look for those people that are jumping on board now going, oh, crap. You know, if they start to take it apart, if a piece of news comes out that reverses that whole pundit story, there'll be a stampede for the exits. We have seen this before. Right there. Rejection. Right here. Rejection. Right here. Big rejection. Big. Whatever was going on, big. And now we're going to get a return to it. Interest rates went up on the long end of the curve last week. And remember the day, I think it was Thursday, when that auction took place? Did anybody notice what the long bond did? It dropped over 2 points. But they continued to buy the S&P and the NASDAQ and the equity markets. Why? Because they were headed for Friday. They were headed for the expiration. All of this was already put in place. The squeeze was already underway. You're looking over there going like, we shouldn't be going up. The interest rates aren't going down. This whole inversion thing may be ending. the Fed's not getting the right information. Maybe they are going to hike it 3/4 of a point, or 75 basis points. Again, it's out there. So I am looking, but we cannot, or I cannot say it's underway now. Don't have enough information. So what am I looking for? I'm looking again. I talked about it. This one is the last one. I said, if I could see 5 down, that's going to give me support where that this high completed that move that we're counting. I only got 3 down. 1, 2, 3, 4, 1, 2, 3, 4, 5. But it's not a 5 of a larger 5. It's 5 of 5. It's like it's getting there. But we can get up to 4,300. We can. They're not selling this, and it's sitting on the hourly 4. Granted, they still have an hour before the Asian markets wake up and come in and start trading, and then we have the European markets, and then it comes back to the U.S. Lots can happen around the world and also within trading. But what I'm going to be looking for, I'm going to leave open the possibilities that we, again, can find ourselves rallying. But I'm going to be paying attention to the volume. If we rally again on light volume, it's just like because the sellers are waiting and they're not giving anymore, or they've had to cover and they're not pleased. So you want to keep buying, push. And as an ex-trader, as an ex-floor trader, it's like, sorry. And that works both ways, folks. It works both ways. It's like when a market is really dropping quick and you need to buy your puts, and you own the puts, I'll give you 2 lot there. I need 100. I'm sorry. You can buy 2 or 5. What's the market after? And I'm literally telling you the truth. You can mark that market down $1 or 2, and they say buy them. So when in need, AKA Friday's short cover. Where's the offer? And of course, this is all being done electronically, so it's not even you get a chance to negotiate it. It's pushing a button to buy it at the market. It just flew higher in search of value. So again, I go back to the order flow volume profile information. What are we looking at? Supply and demand. The demand was on the buy side. The supply was not there. So what happens? The market will go to value. What do I mean by value? Value is where the buyer and seller get to exchange and do business. It does not mean that 4,300 is value. That's the proper value for the S&P. That I can't tell you. Is it a correct trade? Yeah. Buyer said I'll pay 4,300. Seller said I'll sell it to you at 4,300. Perfect trade, perfect price. What's wrong with it? Nothing. It happened. Somebody was willing to buy it. Somebody's willing to sell it. Perfect trade. And always correct. So again, does not mean, if I'm saying that, it doesn't mean that I think that we're at a good level, a sustainable level, a level that really is going to be an additional launching pad to a rally. If anything else, remember under view number 2, we would be looking for an intermediate B wave down. What will be inside that intermediate B wave is an ABC structure of minor degree. So we need a minor A, minor B, minor C. A and C could be 5 waves. As I just demonstrated, we have potential, folks, that we can come down to 38. Down in here, 38.50, 38.25. We can come down that far in a B wave. That'll be 200 points away. So 38, and we're up at 42, 43. That's 500 points down. Wow. Is that a tradable decline? Sure is. But know how you're doing it. Know what you're going to trade, why you're trading it, what's your entry, what's your exit. Figure your plan out. Don't just jump because somebody's saying we're bullish or bearish. they have a little bit of understanding. When this thing turn happens, you will have signs, you will have clues of what the market is going to do. We have moving averages. We have, on a day-to-day basis, we have points of control. We have value area highs, value area lows. We have extended. We have all kinds of things that can give us hints. We have daily charts, hourly charts, weekly charts that can help us put together a picture. We have indicators. We have and indicators via news. These reports continue to come out. How they want to spin it is where you've got to put that aside and look at the price action and look at what's possible. Let the market decide what the market wants to do, but be aware of what's out there. Do not get yourself into an option contract that trades by appointment. You want to be in liquid markets where the bid and the offer are relatively about a tick or two away from one another. They might widen out, but when they get so wide that you're stuck, don't do it, because if you bought too many, you won't get out. You'll be back in that situation I just described. I need to buy these puts. Oh, okay. Well, here's your price. Buy them. I'll sell you two. What's the offer after? $1 higher. Buy them. How many you need? 98. I'll sell you two. Supply and demand. Where's the value? It all comes into play. Now, tomorrow, I would suspect that we can run back up. If we're going to start falling, I'm going to go back down to the hourly chart, and then I'm going to go over to the NASDAQ. So please, I hope you're all standing here and you're able to relate all of this to the whole shebang. If this is 4, which is actually, I'm going to have to leave it then. It's 1, that's 2, that's 3, that's 4, and it's 1, 2, 3, 4. And we got a little bit of a 5. I don't think it can get very high, but we know it can get to 43. On the way down, hourly, it's got to break the 4, the 8. More importantly, I'm looking for the break below the 8 and the break below the 20. Then I'm definitely looking for a break below 42.26, which is where the 50s are, both SMA, EMA. And then again on the 50 SMA, EMA. The 200 SMA, EMA is at 41.62. Ultimately, I'm looking for 5 waves down to kick off this next move, regardless of what it is. I still want to see 5 waves down to just announce that it's in progress. And I would definitively be looking for a quick trip down and a break back towards 4,100 down to 4,000. Now, we saw that last week, excuse me, on Thursday in the NASDAQ. In fact, I'm going to go over there right now. Let's talk about the NASDAQ. So right there, excuse me, where we raced up on the PPI and then rejected it for the balance of the day. But remember back what I said here. We have to leave open that the market will turn around and just buy all of it back and then some and break above 13,578, which was the high there. And it did. And it did. And it kept going. Well, actually, it went not that much further. That's not, hold on. Now, what is this high? Yeah, 575. But it dropped all the way back down to 292, 93, 94. And then rallied all the way back up. It was very incredible. And it didn't just run. It was slow. It was steady. It was painful to watch because you knew lack of sellers and people were getting closed out. When you are forced to cover your trade, and if you don't, your clearing firm will, and somebody's short the future, and they were looking for a move down, first person on the list are going to hate is me. But I want you to understand that what I am talking about does not require what I would consider bad trading. You don't hold on to a position. If it's going against you, regardless of what the count is, regardless of what your heart is telling you, you get out. You close the position because you want to live to trade another day. These are important things to remember. Don't blow your account out. And then the market does exactly what you think it's going to do or what you're in for. Get out. And if you're really convinced of one side or the other kicking in, wait for it to start and then wait for the confirmation and then trade. Now, NASDAQ. Well, they were going to open it down. They did get it down. And now they're really beginning to bring it back up to neutral. So what did they do? They brought it down below the hourly 4, which is amazing. So still we have an absence of sellers. And I don't blame them. If you had to sell, you had a reason. And you got out. And they're not, and the buyers are like, well, we're going to sit right here. Because I for whatever reason. But if the tops are in, now in the NASDAQ, let me just run those numbers so that we can see. I have those numbers. This would be for a continuation of the 5. And actually what I had on Friday was 13,716. And I'm like, wow, I don't think it's going to get there. So, but we're up as high as 83. We undoubtedly will see some resistance at 13,600. Back and forth, back and forth. We'll watch, see how value areas move around there. But as far as fib resistance, the next we have is 13,716. Now I'm going to put up some additional fibs, which would go more with a larger. If this is going to be a primary B wave, and we're looking for where wave A of that B wave can come in. There, oh, crap. All right, well, these are just estimates. So we see that right now that the NASDAQ on the daily basis is sitting right below the daily 200. Come on, computers. Already long enough. There. Okay, so here's what we got. We have really nothing until 13,900 on that basis, but we know 13,600, then we had 13,778. That was before, just what we saw before, which would be for the wave 5. So this wave 5, obviously, activate, move. I'm going to bring it out over there. This will all move as well. But we are open. I can actually put in the other one. So we're going to double them up here and see what we got. Do that real quickly. Thank you all for actually listening and hanging out, if you're still hanging out, to hear this analysis for tomorrow. We're going to go up, go to the 3, go down to there. May not be the most accurate, but now we're looking. We overlap. So we have 13,695, so 13,700-ish. And then we have 900, 13,900. And then we're looking at 14,000. Can it go there? Sure, it can go there. Undoubtedly, it can go there. And it'll be spun as the bullish since the most bullish since 1927 or whatever number they want to make up. Point being, can it go there? Yes. If you're short and you're trying to ride out a short squeeze, it's really a mistake. It's just not good trading. You're going to lose a lot more money. You need to wait before this. See, now what happens now? You start to lose, and now you're down almost your entire account. But you're praying, you're hoping, you're praying. When maybe you could have gotten out when you were down almost nothing. Like, oh, this one's not going to work. We're seeing higher, higher, higher. I'm out. And either you decide to join the party, but again, not on the basis that, I'm looking to make a home run. You're trading. You're just trading. But if it's going to go up, you don't have to fight it. Go with. Actually, Friday, you would have made a ton of money. Just because it didn't stop and it was only one-sided. Back to the market. We do have the fibs, but again, when this thing is done and it starts to come off on the daily, I'm looking same deal. We do have, look at all these moving averages. We're right here at the 200. That's the last line of defense on the daily chart. And it's holding, and it may continue to hold. And somebody else might come in and go, boom, we're done. Don't know. Or to go up and head for that SMA. Again, institutional traders, that's the one they look at. Why? I'm told because a lot of retail looks at SMA and not EMAs. So that's where it is. So that's 14,000. They might just push it there. The whole folly continues, but it may. The market will turn. The market will fulfill its destiny, whether it's an intermediate A or a minor 2. Destiny will be fulfilled here. The wave count, I still feel pretty strong about. I do not estimate or, excuse me, I am not looking for new highs in the NASDAQ or the S&P. Not right now. Maybe once this, if it turns out that it's an intermediate degree A wave and an intermediate degree B wave, then as a part of a primary B wave, then yeah, we could go up, and yes, we could make a new all-time high. Very possible under that scenario. Now, am I going to hang my hat on it? No, because there's just as much probability or possibility that it doesn't get much above 14,000. Dies, comes down, goes all the way back down towards that, I'm serious, towards 11,068, turns and comes all the way back up. That's called an ABC flat. And on a primary degree, yeah, it could be that big. Again, when you're deciding and you're looking at it and you're using Elliott, consider degree. A primary degree move should take more than a month and a half, more than 3 or 4 months. So we're looking at this primary degree. A B wave could maybe take us another month or 2. And look where we're sitting, right at that September picture. So if we get a this intermediate B wave done, get that an intermediate C wave to complete the primary B wave, and we're up here, and September rolls around, and guess who meets again? I want to get more information about inflation. We get lots more information. So there's still a lot out there. Now, tomorrow, again, I'm just going to try to focus real quick on tomorrow. I do think that, yep, we could start to come down, but I'm looking for upside first. I will play it too, folks. You don't have to get married to a position. Please understand that. When I am as a day trader, and I'm trading off of very short-term charts, little tiny short-term charts. I did that on the opening today. I'm looking at little 1-minute charts. And then I have all of my points of control, and I got all of my, where my value area high, where the range is, value area low, range. I have a lot of stuff on here that tells me what to do. I'm trading for the minute. I'm looking at like, okay, my minimum, I'd like to make between $100 and $200 because for a fast moving market, you never know what it's going to do. Gives you 100 and you're not sure. Thank you. And normally I have to be honest with you, when it's up there, it gets to be like 150 to 250 because things are moving pretty fast in the NASDAQ and actually in the S&P as well. So upside 13,600, 13,650, 13,778, I think we had. And then we're looking up above 13,900. We do have potential that we're going to get up to that daily SMA, and that's at 14,000. Downside, same scenario, folks. I'm looking for it to break hourly, start breaking below all of these, and then in the S&P, we're looking for it to eventually get back below 4,000, and I would think pretty quickly. In the NASDAQ, I'm looking at 13,000. I think that should happen pretty quickly. It happened damn quick going back up. It took a day, 1, 2, 3, 4 days to go from 12,954 to 13,500, almost 600. So didn't take that long. Shouldn't take that long to come back off. Could be great trading. I'm going to wrap it all right here. Again, thank you so much for hanging out with me, for listening. Hopefully a little bit cleaner views on how I use Elliott and what Elliott does and why. Elliott is not wishy-washy. Elliott is not, maybe this, maybe that. It gives you choices. Fortunately, what we're looking at right now is that when we're going up, it's not to new highs. I don't need to adopt or take on a bullish or bearish posture to trade. I can trade the price action. You can too. And I'm going to wish everybody a really great trading day tomorrow. Thank you again for listening. Again, this is the Elliott Wave Eye of the Storm for August the 14th for the NASDAQ and the S&P. Next update will be separated, and it will come on August the 15th.